Advanced Taxation, Chapter 5, Capital Gains Tax. Content: 1. Purpose. 2. Nature and objectives of capital gain tax. 3. Administration and objectives of capital gain tax. 4. Allowable and disallowable expenditure. 5. Rate. 6. Computation of chargeable gains. 7. Exemption and capital gain tax. 8. Disposal and acquisition of assets. 9. Reliefs. 10. Offences and penalties. 11. Other matters. 12. Chapter review. 13. Worked examples. Capital gain tax. Purpose. After studying this chapter, readers should be able to A. Know how capital gain tax is administered. Understand the nature and objectives of capital gain tax. Understand the principle of allowable and disallowable expenditure as applicable to capital gain tax. Know the chargeable gains that are exempted from capital gain tax. Understand all the capital gain tax issues involved in acquisition and disposal of assets. Know the reliefs available in capital gain tax and be able to prepare capital gain tax computation in accordance with the provision of the Capital Gain Tax Act, Cap C1 LFN 2004. Subtopic: Nature and objectives of capital gain tax. In the usual income tax computation, profits or losses on disposal of fixed assets are excluded by means of adjustment to the relevant accounting results. At the same time, balancing adjustments would be made in the capital allowance computation in respect of the difference between the proceeds of disposal and the tax written down value of such assets. Balancing allowance will be granted if the proceed falls short of the written down value, and the balancing charge if the proceed is higher. In the latter case, if the proceed is greater than the cost, the amount of the balancing charge would be restricted to the amount of capital allowance previously granted. This will be the difference between the cost of acquisition and the tax written down value of disposal. In such a situation, another surplus, that is, the difference between the proceed and the cost, which has not been subjected to any taxation treatment, arises. In taxation law and practice, all transactions of capital nature are excluded from income tax. In view of the fact that the surplus referred to is a capital receipt, it cannot be included in gain or profit for income tax purposes. However, such capital gains are subject to capital gain tax (CGT) under the Capital Gain Tax Act (CGTA). The Capital Gain Tax Act, enacted in 1967, came into effect from the 1967/68 assessment year. In addition to the necessity to charge capital gain to tax as illustrated above, the Act would also have been introduced to produce an additional source of revenue to government to finance Nigeria's civil war. The principal act, together with all amendments thereto, has been reenacted as Capital Gain Tax Act, Cap C1 of the Laws of the Federation of Nigeria, LFN 2004, as amended. Subtopic: Administration of capital gain tax. The management of the Capital Gain Tax Act with respect to corporate bodies, individuals resident in the Federal Capital territory (FCT), and non-resident individuals, that is, individuals outside Nigeria, is placed under the administration of the Federal Inland Revenue Service. This is with regards to returns, assessments, appeals, collections, recovery and repayments, offences and penalties, as well as litigations. The management of the Act with respect to individuals, except non-residents, is placed under the administration of the State Board of Internal Revenue. Certain provision of the Income Tax Act shall apply in relation to capital gain tax as they apply in relation to income tax chargeable under those acts, subject to any necessary modifications. Appeals against any assessments to capital gain tax shall be made in accordance with Section 54 of CETA or Section 53 of the PITA, as the case may be, to the Tax Appeal Tribunal established under the Companies Income Tax Act, Section 43, subsection 2 of CETA. Capital gains. Capital gains may be defined as gains arising from increase in the market value of capital assets to a corporate body or person who does not habitually offer them for sale and in whose hands they do not constitute stock in trade. It is the difference between the consideration accruing and sums excluded from the consideration, being costs and ancillary cost of disposal of a capital asset. One guiding principle is to examine the purpose for which an asset is bought and or sold. When an asset is acquired and or kept for use as an investment, proceeds on the disposal of any such asset shall be treated as a capital receipt, and any gain thereon will be regarded as capital gain. On the other hand, where fixed assets are kept and sold regularly for gains, that is profits, such disposal proceeds shall be treated as normal income receipts and taxed under the Personal Income Tax Act or Companies Income Tax Act. CGT imposition. The tax is imposed on gains arising out of the ownership of a capital asset changing hands, either by exchange, transfer, sales, or gifts. The Act as it is presently is silent on gains arising from the appreciation in value of an asset, which has not changed hands over time. Capital gain tax is chargeable on the total amount of the chargeable gains arising after deducting allowable expenses on the disposal of chargeable assets in a year of assessment. Year of assessment. A year of assessment in relation to capital gain tax means a year beginning with 1 January and ending with 31 December in the same calendar year with effect from 1969. Subtopic: Allowable and disallowable expenditure. Deductions allowable. Section 14. A. Cost of acquisition or purchase price, including all costs incidental to the purchase. B. Improvement costs wholly, reasonably, exclusively, and necessarily incurred. C. Costs wholly, reasonably, exclusively, and necessarily incurred in establishing, preserving, or defending the owner's title to a right over the assets. D. Incidental cost of disposal. This includes A. Fees, commissions, or remuneration paid for professional services of surveyor or valuer, auctioneer, accountant, agent, and or legal advisor. B. Cost of transfer or conveyance, including stamp duties. C. Advertisement cost to find a seller or buyer. And D. cost reasonably incurred to make any valuation or appointment required for the purpose of computing the capital gain, including expenses in ascertaining market value where required. Disallowable expenditure. Sums allowable as a deduction in computing the profit or gain or losses of a trade for income tax purposes are not allowable deductions under Section 14 above. Insurance premiums on the assets are not allowable. Section 16. Subtopic Rate. Capital gain tax (CGT) is chargeable at 10% on capital gain arising from disposal of assets. 20% applied up to 31 December 1995. Computation of chargeable gains. Section 3 CGT Act defined chargeable assets as meaning all forms of property whether situated in Nigeria or not, and including a. Options, debts, and incorporeal property generally. B. Any currency other than Nigerian currency. And C. Any form of property created by the person disposing of it, otherwise coming to be owned without being acquired. D. Stock and shares of every description excluded from chargeable assets with effect from 1/1/1998. In respect of assets outside Nigeria, and 1. Disposed by non-resident individuals, or 2. Trustee or trust or settlement, or 3. A company whose activities are managed and controlled outside Nigeria. CGT is chargeable on that part of the gains, if any, received or brought into Nigeria when they are so dealt with. Section 4. This is what is termed remittance basis. The amount of the gain chargeable is dependent on the whole or part which is remitted to Nigeria. If there is no remittance to Nigeria, there is no liability to capital gain tax in respect of the disposal of those fixed assets. Capital loss on disposal of any asset is not deductible from capital gain or disposal of any other asset, even if both are of the same type. Subtopic Exemptions from capital gain tax. The following are exempt chargeable gains. A. Gains accruing to 1. The ecclesiastical, charitable, or educational institution of a public character. 2. Any statutory or registered friendly society. 3. Any cooperative society registered under the Cooperative Society Law of any state. And 4. Any trade union registered under the Trade Union Act. Insofar as the gain is not derived from any disposal of any asset acquired in connection with any trade or business carried on by the institution or society, and the gain is applied purely for the purpose of the institution or society, as the case may be. B. Gains accruing to any local government council. C. Gains accruing to any company being a purchasing authority established by or under any law in Nigeria, empowered to acquire any commodity in Nigeria for export from Nigeria. or gains accruing to any corporation established by or under any law for the purpose of fostering the economic development of any part of Nigeria, insofar as the gains are not derived from the disposal of any assets acquired by the corporation in connection with any trade or business carried on by it, or from the disposal of any share or other interest possessed by the corporation in a trade or business carried on by some person or authority. D. Gains accruing on disposal of investments held as part of any superannuation fund or other statutory retirement benefit scheme to the same extent as income derived from the asset will be exempt under Section 20 of PITA. Disposal of a right to or any part of any sum payable out of any superannuation fund shall also not be chargeable. Superannuation fund means a pension, provident or other retirement benefit fund, society or scheme approved by the Joint Tax Revenue Service under Section 21, subsection 1G of PITA. E. Gains accruing on disposal by any person of a decoration awarded by valor or gallant conduct, which he acquires otherwise than for consideration in money or money's worth. F. Gains accruing from a disposal of Nigerian government securities. Nigerian government securities include Nigerian Treasury bonds, savings certificates, and premium bonds issued under the Saving Bonds and Certificate Act. G. Gains accruing on disposal of land compulsorily acquired by an authority having and exercising such power. H. Gains accruing in connection with the disposal of an interest in or the right under any policy of assurance or contract for a deferred annuity on the life of any person. Some of the other exemptions and relief provisions in the Act are as follows. 1. Section 35 exempts sums obtained by way of compensation or damages for any wrong or injury suffered by an individual to his person or in his profession or vocation. This includes wrong or injury for libel, slander, or enticement. Sums obtained by way of compensation for loss of office exceeding 10,000 in any year of assessment is, however, chargeable. Two, Section 36 exempts gain accruing on disposal of a dwelling house with a maximum land area of up to 1 acre or such larger area as the Revenue Service may determine, which has been the individual's only or main residence throughout the period of ownership up to the time of disposal or up to the last 12 months before the date of disposal. So far as it is necessary for the purpose of this section to determine which of two or more residents is an individual's main residence for any period, the individual may conclude that question by notice in writing to the Revenue Service given within 2 years from the beginning of that period. This can be varied by a further notice in writing to the Revenue Service as respects any period beginning not earlier than 2 years before the giving of the further notice, and the question shall be concluded by the determination of the Revenue Service. The individual may appeal to the appeal commissioners against that determination within 30 days of service of the notice by the Revenue Service. 3. A gain accruing on disposal of tangible and movable assets shall not be chargeable gain if the total value of the consideration does not exceed 1,000 naira in a year of assessment. If the proceeds of disposal exceed 1,000 naira in an assessment year, the amount of CGT chargeable on the gain shall not exceed half the difference between the amount of that proceed and 1,000 naira. 4. A motor vehicle for carriage of passengers is an exempt asset for CGT purpose unless it is of a type not commonly used as private vehicles and is unsuitable to be so used. 5. Section 39 exempts assets acquired by way of gift and disposed of in a similar manner. 6. Section 40 exempts capital gain accruing to a diplomatic body. 7. Double taxation relief is applicable to CGT as it is applicable to income tax under PITA and companies income tax under SITA, with the situation of the word's capital gain for income and profit and CGT for income tax. 8. The following exemptions have been included with effect from 1993. Gains arising from takeover, absorption, or merger, provided that no cash payment is made in respect of the shares disposed or acquired. Gains arising in respect of disposal of securities in a unit trust, provided the proceeds are reinvested. Stock and shares of every description are exempted with effect from 1st of January 1998. Subtopic: Disposal and acquisition of assets. Meaning of disposal. Except as specifically exempted by the Act, there is a disposal of assets by a person where any capital sum is derived from a sale, lease, transfer, assignment, compulsory acquisition, or any other disposal of assets, notwithstanding that no asset is acquired by the person paying the capital sum, and in particular, A. Where any capital sum is derived by way of compensation for any loss of office or employment. B. Where any capital sum is received under a policy of insurance and the risk of any kind of damage or inquiry to, or the loss or depreciation of assets. C. Where any capital sum is received in return for forfeiture or surrenders of rights or from refraining from exercising rights. D. Where any capital sum is received as consideration for use or exploitation of any asset. And E. Without prejudice to paragraph A above, where any capital sum is received in connection with or arises by virtue of any trade, business, profession, or vocation. It is also stated in the Act that disposal includes reference to part disposal. When an acquisition or disposal is effective. Acquisition or disposal takes effect on the date of the contract to acquire or dispose of the assets, or on a date at which there is an enforceable right to acquire or a binding duty to dispose of the assets or any right or interest therein, and in particular, A. Where any contract is to be performed subject to any condition. The date of acquisition or disposal shall be the date when the condition is satisfied, but where a consideration of such contract does not depend solely or mainly on the value of the asset at the time the condition is satisfied, the acquisition or disposal shall be treated as if the contract had never been conditional, in which case the effective date shall be the date of the contract. B. Where an option is conferred by virtue of any contract, the date of the acquisition or disposal of assets shall be the date when the option is exercised. Hire purchase transaction. Where a fixed asset is purchased under hire purchase, the cost for tax purpose is the cash price of the asset. The higher purchase charges, which represent the interest charges, are allowable deductions under Section 20 of CETA in arriving at the assessable profit. Thus, for capital gain tax purposes, if all the installments have been paid before the date of disposal, it is the full cash price that is taken as the cost for capital gain tax purposes. If the installments have not been fully paid, the cost of the asset at the time of disposal will be the cash price portion of the installments paid to the date of disposal. Illustration 5.1. Union Company Limited purchased a chargeable asset on hire purchase. The deposit paid for the purchase was 250,000 naira. The balance of the purchase price was to be paid in 36 monthly installments of 25,000 naira. The cash price of the asset is 790,000 naira. Required, calculate the capital gain tax due. The capital gain tax due, assuming the assets were sold as follows. A. For 1.25 million naira after payment of 24 installments. B. For 1.3 million naira after full payment of all the installments. Suggested solutions. Here we have for A, where we said for 1.25 million after payment of 24 installments. So we said A, solution to A, disposal after 24 installments paid. Sales price, so that is 1.25 million naira. Less cost of the asset. The deposit was 250,000. The installments paid totaled, that will be 24 installments multiplied by 24,000. That gave us 600 naira. Then you less interest element. The interest element is 24 multiplied by 10,000 naira. That gave us 240,000. So 600 minus 240,000 gave us 360,000 naira. The addition of deposit and the 360,000 gave us 610,000. So the sales price of 1.25 million multiplied by the 610,000, we arrived at 640,000, which is the capital gain. Then the capital gain tax at 10% thereof is 64,000 naira. The solution to B goes thus. Disposal after full payment of all installments. The sales price was 1.3 million, so we less the cost. The cost is made up of our deposit of 250,000, the installments paid, that is 36 installments multiplied by 25,000 naira, which gave us 900,000. Then you less the interest element, which is 36 installment times 10,000 naira, which gives us 360,000 naira. 900,000 minus 360,000 gave us 540,000. 540 plus the deposit of 250 gives us 790,000. So the sales price of 1.3 million minus 790,000 gives us the capital gain of 510,000, where therefore capital gain tax at 10% is 51,000 naira. Calculation of interest element of each installment. The deposit is 250,000 naira. Total payable by installment, that's 36 times 25, which gives us 900,000. Then the total hire purchase price is 1,150,000 naira, less the cash price of 790,000 naira. That gives us 360,000, which is the total interest element. Then the total number of installments is 36, which gives us 360,000 divided by 36. Therefore, the interest element of each installment is 10,000 naira. For simplicity, the interest element has been apportioned on the straight line basis. Bargains comprising 2 or more transactions. Section 20 CGTA provides where a single bargain comprises 2 or more transactions whereby assets are disposed of, those transactions should be treated for the purpose of computing capital gain as a single disposal. Where separate considerations are agreed or purported to be agreed for any 2 or more transactions comprised in one bargain, whether transactions whereby assets are disposed of or not, those considerations shall be treated as altogether constituting an entire consideration for the transactions and shall be apportioned between them accordingly. Where any apportionment under this section shall result in lesser consideration than that agreed or purported to be agreed in the bargain being attributable to the disposal of the assets, the separate consideration agreed in respect of those assets shall be deemed to be the consideration for which those assets are disposed of. Part disposal. Where there is a part disposal, the cost of that part of assets disposed and that of the undisposed part shall be apportioned. The cost to be apportioned to the part disposed shall be the proportion that the consideration for the disposal bears to the total value of the whole asset on the date of the disposal. The value of the whole asset on that date is the consideration received in respect of the part disposed plus the market value of the part of the asset which remains undisposed. Thus, if A is the consideration received in respect of that part disposed of, and B is the market value of the part which remains undisposed, then the apportionment will be based on the formula A divided by A plus B, which shall be applied in computing the cost and or all other sum available as a deduction in computing the amount of the gain accruing on the disposal, the remainder being attributable to the property which remains undisposed of. Connected persons. In tax practice, certain persons are treated as being so closely involved with each other that they have to be viewed as the same person, or that transactions between them need to be treated differently from those at arm's length. These persons are referred to as connected persons. Transactions between such persons may be regarded as artificial or fictitious for the purpose of determining the tax liability arising therefrom. This implies that the revenue can make whatever adjustment as it considers necessary to counteract the reduction of liability to tax that could otherwise result from such transactions. Transactions between connected persons. Where a person acquires an asset and the person making the disposal is connected with him, the person acquiring the asset and the person making the disposal shall be treated as parties to a transaction made otherwise than by way of a bargain at arm's length. The consideration shall be disregarded if less than the market value, and the consideration shall be deemed to be the market value. Connected persons. A. An individual is connected with his or her spouse and with his or her relatives and their spouses. B. A trustee of a settlement is connected with the settlor of that settlement and with any person connected with the settlor. C. A partner is connected with the person with whom he is in partnership and with the spouse or relative of that person. D. A company is connected with another company if the same person controls both, or one is controlled by a person who has control of the other in conjunction with persons connected with him, or a person controls one company and person connected with him control the other, or the same group of persons control both, or the companies are controlled by separate groups which can be regarded as the same by interchanging connected persons. E. A company is connected with another person who, either alone or with persons connected with him, has control of it. And F. Persons acting to secure or exercise control of a company are treated in relation to that company as connected with each other and with any other person acting on the direction of any of them to secure or exercise such control. Relative is also defined in the Act as meaning brother, sister, ancestral, or linear descendants. Consideration. Consideration for assets acquired or disposed of shall be deemed to be equal to the market value of the asset where any person acquires the asset A. Otherwise than by way of a bargain made at arm's length. B. Wholly or partly for a consideration that cannot be valued or in connection with his own or another loss of office or employment or diminution of emolument, or otherwise in consideration for or recognition of services or part services. C. As trustee for creditors of the person making the disposal. Where a person donates an asset acquired by him by way of a gift, not being an acquisition or a devolution on death or otherwise, the person receiving the donation shall, for all purpose of the Act, so far as it relates to the interest taken by him, be deemed to have acquired the asset. 1. In a case where the amount of the consideration for which the asset was last disposed of by way of a bargain made at arm's length is ascertainable for a consideration equal to that amount, and 2. In any other case, for a consideration equal to the market value of the asset on the date of that disposal, and this subsection gift does not include a donation motus causa. The conveyance or transfer by way of security of an asset, including a retransfer on redemption of the security, shall not be treated for the purpose of the Act as involving any acquisition or disposal of the asset. Where a person entitled to an asset by way of security or to the benefit of a charge or encumbrance on an asset deals with the asset for the purpose of enforcing or giving effect to the security, charge or encumbrance is dealings with it shall be treated for the purpose of the Act as if they were done through him or nominee of the person entitled to it, subject to the security. Charge or encumbrance and this subsection shall apply to the dealings of any person appointed to enforce or give effect to the security. Charge or encumbrance as receiver and manager or judicial factor as it applies to the dealings of the person entitled as aforesaid. An asset shall be treated as having been acquired free of any interest or right by way of security subsisting at the time of any acquisition to it, and has been disposed of free of any such interest or rights subsisting at the time of the disposal, and where an asset is acquired subject to any such interest or right, the full amount of the liability thereby assumed by the person acquiring the asset shall form part of the consideration for the acquisition and disposal in addition to any other consideration. Where an asset is acquired by a creditor in satisfaction of his debt or part thereof, the asset shall not be treated as disposed of by the debtor or acquired by the creditor for a consideration greater than its market value at the time of the creditor's acquisition of it. And if a chargeable gain accrues to the creditor on a disposal by him of the asset, the amount of the chargeable gain, when necessary, shall be reduced such that it will not exceed the chargeable gain which would have accrued if he had acquired the asset for a consideration equal to the amount of the debt or that part thereof. Any amount that can be treated as income or profit for the purpose of the Income Tax Act shall be excluded from the consideration for a disposal of assets for capital gain tax computation. Subtopic: Consideration payable by installment. When the consideration is payable by installment over a period exceeding 18 months, the chargeable gain accruing on the disposal shall be regarded as accruing on proportionate parts in the year of assessment in which the disposal is made, and in each of the subsequent years of assessment up to the assessment year in which the last installment is payable in the proportion of the amount of the installment payable in each of the years. Such chargeable gain shall be deemed to accrue on the last day of each of the year of assessment in which the installments are received. No allowance is given for possible bad debts at the time of computing the capital gain tax payable. However, if any part of the consideration already brought into the computation is subsequently shown to the satisfaction of the revenue service as irrecoverable, such adjustment, whether by way of discharge or repayment of tax or otherwise, shall be made as is required in consequence. Debt, Section 8. On the debt of an individual, any asset of which he has competence to dispose of shall, for the purpose of the Act, be deemed to be disposed of by him at the date of his death and acquired by the personal representatives or other person on whom the assets devolve for a consideration equal to a. The amount of the consideration for which the asset was last disposed of by way of a bargain made at arm's length if ascertainable, or b. In any other case, the market value of the asset at that date. The gains which accrue in consequence of subsection 1 of this section shall not be chargeable to capital gain tax under the Act. Subsection 2. The personal representatives shall be treated as having the deceased residence and domicile at the date of death. On a person accruing any asset as legatee, 1. No chargeable gain shall accrue to the personal representatives, and 2. The legatee shall be treated as if the personal representative's acquisition of the asset had been his acquisition of it. In this section, legatee includes any person. In this section, legatee includes any person acquiring an asset under a testamentary disposition or on an intestacy or partial intestacy, whether he takes beneficially or as trustee, and a donation motus causa shall be treated as a testamentary disposition and not as a gift. Personal representatives means A. The executor, original or by representation, or administrator for the time being of a deceased person under any law in force in Nigeria. B. Persons having in relation to the deceased under the law of another country any function corresponding to the function of administration purposes under any law in force in Nigeria, or personal representative as defined under paragraph A of this subsection, and references to personal representative as such shall be construed as reference to the personal representative in their capacity as having such function as aforesaid. Asset lost or destroyed. If a capital sum is received by way of compensation for the loss or destruction of an asset, whether under a policy of insurance or not, a relief is available to the owner if the amount is applied within 3 years of receipt in acquiring a replacement of the asset lost or destroyed. The owner can claim A as if the consideration for the disposal of the old assets were of such amount as would secure that neither a loss nor a gain accrued to him on the disposal, and B. as if the consideration for the acquisition of the new assets were reduced by the excess of the amount of the capital sum received, together with any residual value or scrap value over the amount of the consideration, which is treated as receiving under paragraph A above. If part of what would have been the chargeable gain is what is reinvested, then the relief available will be proportionally reduced. Subtopic: reliefs. Delayed remittance reliefs. A person charged or chargeable for any year of assessment in respect of chargeable gains accruing to him from the disposal of assets situated outside Nigeria may claim that the following provisions of this section shall apply on showing that A. he was unable to transfer those gains to Nigeria, and B. that inability was due to the laws of the country where the income arose, or to the executive action of its government, or to the impossibility of obtaining foreign currency in that country, and C. the inability was not due to any want of reasonable endeavors on his part. Section 42, subsection 2. If he so claims, then for the purpose of capital gain tax 1, there shall be deducted from the amount on which he is assessed to capital gain tax for the year in which the chargeable gain accrued to the claimant the amount as respects which the condition in paragraph A, B, C of subsection 1 of this section are satisfied so far as applicable, but 2. The amount so deducted shall be assessed to capital gain tax on the claimant as if it were an amount of chargeable gain accruing in the year of assessment in which the said conditions ceased to be satisfied. Section 42, subsection 3. No claim under this section shall be made in respect of any chargeable gain more than 6 years after the end of the year of assessment in which that gain accrues. Section 42, subsection 4. The personal representative of a deceased person may make any claim which he might have made under this section if he had not died. Subtopic: rollover relief. Section 32 CGT Act. If the consideration received on disposal of an old asset used only for the purpose of a trade is applied in acquiring a new asset in replacement to be used for the purpose of the trade, and the old asset and the new asset are within one and the same one of the classes of assets listed in the Act, the person carrying on the trade shall, on making a claim as respects the consideration which has been so applied, be treated for CGT purpose as if the a. consideration of the disposal of the old asset were of such amount as would secure that on the disposal neither a loss nor a gain accrues to him, and b. value of the consideration for the acquisition of the new asset were reduced by the excess of the value of the actual consideration for the disposal of the old asset over the amount of the consideration which is treated as receiving under paragraph A above. The foregoing will not have any effect on the parties to the transactions involving the old or new assets other than the claimant. This is to say that the purchaser of the old asset will still be treated as acquiring that asset at the price which he has paid for it, while the seller of the new asset will be treated as having sold the new asset at the price he received for it. Illustration 5.2. Mr. Niger sold his factory building which he acquired 10 years ago for 500,000 naira. The cost of acquisition at that time was 100,000 naira. He acquired a new factory for 750,000 naira to enable him carry on his business. Suggested solution. For CGT purpose, and upon Mr. Niger making a claim, he will be treated as if neither a loss nor a gain accrues to him on the disposal. That is, the proceeds of disposal will be taken to be equal to the cost, which is 100,000 naira, and therefore no capital gain is payable. And B, if the cost of acquisition of the new assets, 750,000 naira, were reduced by the excess of the actual proceeds of disposal of the old assets, that is the 500,000 naira, over the amount of the proceeds which is treated as receiving under paragraph A, 100,000 naira, that is 400,000 naira, which would otherwise be the capital gain on the disposal of the old asset, will be deducted from the cost of the new asset. Thus, the cost of the new asset for capital allowance and CGT purposes will be 350,000 naira, that is 750,000 minus 400,000 naira. This is what is referred to as rollover relief in CGT practice. The liability to CGT on gain which have been fully reinvested in the same asset used for the same trading being deferred until the replacement asset is finally disposed. Note that where the insurance compensation money for the loss or destruction of a capital asset is applied within 3 years of receipt, in acquiring a replacement asset, the above shall also be applicable if the owner so claims. Continuing with the example of Mr. Niger from above, the purchaser of Mr. Niger's factory will not be affected by this arrangement, neither will the seller of the new factory, as they will record their transaction as having purchased and sold the factory for 500,000 and 750,000 respectively. If only part of the proceeds of disposal is reinvested and the amount reinvested is greater than the cost of the old asset, the owner, if he so claims, shall be treated as if the amount of the gains so accruing were reduced in the amount of the said part with a proportionate reduction in the amount of the chargeable gain, and B. As if the amount of the consideration for the acquisition of the new assets were reduced by the amount by which the gain is reduced under paragraph A above. In other words, if the proceeds are not fully reinvested, the amount of relief available will be the proportion which the gain reinvested bears to the total gain accruing on the disposal. For the foregoing to be applicable, the acquisition of the new assets should be completed within the period of 12 months before and 12 months after the date of the disposal of the old asset, or at such earlier time as the Revenue Service may by notice in writing allow. Where an unconditional contract for the acquisition has been entered into, this section may be applied on a provisional basis without waiting to ascertain whether the new asset is acquired in pursuant of that contract. When the fact is ascertained, all necessary adjustments shall be made by making additional assessments or by repayment or discharge of tax, and shall be made notwithstanding any limitation in the Act on the time within which assessment may be made. The assets to which this section applies are classified as follows. Class 1 assets. A. Land and buildings and any permanent or semi-permanent structure in the nature of a building occupied as well as used only for the purpose of trade. B. Fixed plant or machinery. Class 2 assets, ships. Class 3 assets, aircraft. Class 4 assets, goodwill. If over the period of ownership or any substantial part of the period of ownership, a part of a building or structure is partly used for the purpose of a trade, this section shall apply as if the part so used is a separate asset. It will be subject to any necessary apportionment for an acquisition or disposal. This section shall apply in relation to a person who either successfully or at the same time carries on two trades which are in different localities, but which are concerned with goods or services of the same kind, as if in relation to old assets used for the purpose of the one trade and new assets used for the purpose of the other trade. The two trades were the same. This section shall apply with the necessary modifications in relation to a business, profession, vocation, or employment as it's applied in relation to a trade. The expression trade, business, profession, vocation, and employment have the same meaning as in the Income Tax Act, but not so as to apply the provision of those acts as to the circumstances in which, on a change in the persons carrying on a trade is to be regarded as discontinued or as set up and commenced. Subtopic: Offences and penalties. There is no special provision in Capital Gain Tax Act relating to offences and penalties. The CGT Act, however, provides that Part 13 of the Companies Income Tax Act, CITA, Cap 21, Law of the Federation of Nigeria, 2004 on offences is applicable to CGT. Please see details of offences and penalties as stated in Chapter 7 of this manual. Subtopic: Other matters. A. Artificial or fictitious transactions. Where the Revenue Service is of the opinion that any disposition is an artificial or fictitious transaction, or where any transaction which reduces or would reduce the amount of any capital gain is artificial or fictitious, the Revenue Service shall disregard such disposition and may direct that such adjustments shall be made with respect to the liability of any person for the payment of capital gain tax as it considers appropriate, so as to counteract the reduction of liability to capital gain tax effected or reduction which would otherwise be effected by the transaction, and any person concerned with such transaction shall be assessable accordingly. Any person in respect of whom any direction is made under this section shall have a right of appeal in like manner as though for the purpose of the Act such direction were an assessment to CGT. Disposition includes any trust, grant, covenant, agreement, or arrangement. Transactions between connected persons shall be deemed to be artificial or fictitious if, in the opinion of the Revenue Service, those transactions have not been made on terms which might fairly have been expected to have been made by persons engaged in the same or similar activities dealing with one another at arm's length. In relation to any direction made under this section, the provision of the Act as to appeal against an assessment shall have effect as if such directions were an assessment. B. Location of assets. For the purpose of the Act, 1. The situation of rights or interests in or over immovable property is that of the immovable property. 2. Subject to the following provision of this subsection, the situation of rights or interests in or over tangible movable property is that of the tangible movable property. 3. Subject to the following provision of this section, a debt secured or unsecured is situated in Nigeria if and only if the creditor is resident in Nigeria. 4. Shares or securities issued by government, municipal, local or native authority or by any body created by such an authority are situated in the country of that authority or place where the authority is situated. 5. Subject to paragraph D of this section, registered shares or securities are situated where they are registered, and if registered in more than one register, where the principal register is situated. 6. A ship or aircraft is situated in Nigeria if and only if the owner is then resident in Nigeria, and an interest or right in or over a ship or aircraft is situated in Nigeria if and only if the person entitled to the interest or right is resident in Nigeria. 7. The situation of goodwill of a trade, business, or professional assets is at the place where the trade, business, or profession is carried on. 8. Patents, trademarks, and designs are situated where they are registered, and if registered in more than one register, where each register is situated. And copyrights, franchise, rights, and licenses to use any copyright material, patent, trademark, or design are situated in Nigeria if they or any rights derived from them are exercisable in Nigeria. And 9. A judgment debt is situated where the judgment is recorded. C. Assets located outside Nigeria. Capital gain is payable on the gains arising in the disposal of assets situated outside Nigeria, so long as the proceeds are received in or brought into Nigeria. The tax is due 1. Where the disposal is by an individual who is visiting Nigeria temporarily with no intent to establish residence, and an individual who spent more than 183 days out of a 12-month period in Nigeria. 2. Where the disposal is by a non-Nigerian company managed and controlled from outside Nigeria. D. Other provisions. 1. Section 22, subsection 1. Market value in relation to any asset means the price which those assets might reasonably be expected to fetch on a sale in the open market. 2. Section 22, subsection 2. In estimating the market value, no reduction shall be made in the estimate on the amount that the estimate is based on the assumption that the whole of the asset is to be placed on the market at one and the same time. 3. Section 22, subsection 3. In re-estimating the market value of any asset acquired, if the market value exceeds the consideration actually paid by the acquirer, the asset shall be deemed to have been acquired for the amount actually paid by the acquirer. E. Anti-avoidance provision. Without prejudice to the provision of the Stamp Duties Act, the minister with responsibility for matters relating to stamp duties shall demand tax clearance certificate when checking documents on sale by any company of landed property and other assets before accepting such documents for stamping. Another anti-avoidance provision has been introduced with effect from 1 January 1993. It makes the provision of evidence of tax payments a condition for effecting change of ownership of property, including shares and stock. Chapter review. This chapter deals with the taxation of gains that cannot be regarded as income. Such gains are classified as capital gains, as they cannot be included in income for income tax purposes. This chapter shows that capital gain tax will be due on chargeable capital gains arising on disposal of capital assets to the extent that such are not specifically exempted by the Act. The current tax of capital gain tax is 10%. Capital loss on disposal of an asset cannot be relieved against the capital gain on another asset, even if the two assets are in the same class. Worked examples. Question 1. Best Manufacturing Nigeria Limited is engaged in the production of building materials in Alta, Ogun State. Due to sudden power surge at night, one of the two factories got burnt before firefighters arrived at the scene. The factories were comprehensively insured with Macom Insurance Company plc. The management decided to move the factory from Alta to Lagos State. Concerted efforts were made to acquire land for a new factory in Ejigbo, and the factory in Alta that was not burnt, which cost 1.8 million 6 years earlier, was sold for 4.2 million in March 2007. The amount formed part of the cost of construction of the new factory at Ejigbo, which was completed in November 2007 at a cost of 5.6 million. In 2008, the Alta factory, costing 3.7 million, the insurance company paid 5.9 million to Best Manufacturing Nigeria Limited. Out of the compensation received, 4.6 million was spent on the construction of the new factory in Ejigbo, whilst the balance was put in fixed deposit account to yield interest. Best Manufacturing Nigeria Limited has just appointed you as the company's tax consultant. Required: advise the management on A. The capital gain, if any, arising from the event. B. The capital gain tax payable. C. How the company can reduce the capital gain tax payable. Solution to question 1. Suggested solution to question 1. XYZ and Co. Chartered Accountant 2. Ayodeji Street, Ikeja, Lagos. O/R/Y/R 15 November 2009. The Managing Director, Best Manufacturing Nigeria Limited, Ejigbo, Lagos State. DESA RE. Advice on tax implications of disposal of a property or insurance claims received on destroyed property. We are in respect of your letter dated 5 November 2009, appointing us as your company's tax consultant and specifically requesting for advice on the following underlisted area: capital gain, if any, arising from the transaction, the capital gain tax payable, and suggestions on way of reducing the capital gain tax. After thorough examination of the information provided in your letter under reference, we state as follows. A. In respect of item A, Appendix 1, show the capital gain for assessment years 2007 and 2008. B. For the assessment year 2007, your company is not liable to capital gain tax for the facts stated under Appendix 1, while for assessment year 2008, the capital gain tax is 130,000 naira as shown under Appendix 2. C. In our opinion, for your company to have a reduced liability on capital gain tax, the full proceeds of 5.9 million should be applied to Ejigbo factories, thus having a full benefit of rollover relief in 2008 assessment year. We have based all our computation on the following provisions of the tax laws. 1. Assets lost or destroyed and replacement of business assets. 2. Rollover relief on reinvestment of disposal proceeds of similar assets. 3. The mandatory period of 12 months of disposal of old assets within which reinvestment occurred. As shown in our computations, your company was liable to capital gain tax in 2008 because the amount reinvested was less than the claim proceeds. Should you require any further clarification or explanation, we would be most obliged to do so. Once again, we use this opportunity to thank you for your understanding and cooperation and for considering us for this assignment. Yours faithfully for XYZ and Co. Chartered Accountant, Peter James, Managing Partner. A. Appendix 1. Best Manufacturing Nigeria Limited. Capital gain for 2007 year of assessment. Disposal of Water Warehouse. Sales proceed 4.2 million. Less cost of acquisition 1.8 million. Capital gain 2.4 million. Amount received in Ejigbo 5.6 million. Capital gains rollover 2.4 million. Reason: the amount reinvested is greater than the sales proceeds. B. Capital gain for 2008 year of assessment. Disposal of Ota Factory. Claim from Macom 5.9 million. Less cost of acquisition 3.7 million. Capital gain 2.2 million. Claim from Macom 5.9 million. Amount reinvested 4.6 million. Capital chargeable gains 1.3 million. Amount rolled over partial. Total capital gain 2.2 million. Less chargeable gain 1.3 million. Amount rolled over 900,000. Total capital gain made on the project. 2007 year of assessment. Disposal of warehouse 2.4 million. 2008 year of assessment. Disposal of factory 2.2 million. Appendix 2. Capital gain tax payable. 2007 year of assessment, nil. 2008 year of assessment, 1.3 million multiplied by 10%, 130,000 naira. C. Ways to reduce the capital gain tax. In order to reduce the capital gain tax, the full proceeds of 5.9 million should be applied to Ejigbo factory so that the company can benefit from full rollover relief in 2008 assessment year. Question 2. Janid Investment Limited sold its 2 buildings situated on Lagos-Badagry Expressway, Amuwo, Lagos, and another in Ibadan. The building in Lagos was compulsorily acquired by the state government in June 2008 in the course of the dualization of the road. A compensation of 25 million was paid for the building, which originally cost the company 2.5 million. Fearing that the same predicament might befall the Ibadan building, the company quickly sold the building for 15.5 million on 6 July 2008. Its original cost was 850,000 naira. Sales expenses amounted to 3,250,000 naira. The company normally makes accounts to 31 December each year, and the properties which were sold and purchased were reflected in the account to 31 December 2008. The company decided to move to Ogun State, where between September and November 2008, it acquired a new site and erected another business building at a cost of 20,500,000. Required: compute the capital gain tax liability for the relevant year of assessment. B. State one other alternative open to Janid Investment Limited in discharging its capital gain tax liability and the time limit for exercising the option. Solution to question 2. Janid Investment Limited. A. Computation of capital gain tax liability for 2008 year of assessment. For Lagos building, compensation or sales proceed is 25 million. Deduct the sales expenses. There was no sale expenses. The net compensation or sale is 25 million. Deduct acquisition cost, which was 2.5 million. The capital gain is 22,500,000. Capital gain tax of 10% is nil. For Ibadan building, the compensation or sales proceed was 15.5 million. Deduct sales expenses of 3,250,000 naira. The net compensation or sales is 12,250,000 naira. Deduct acquisition cost of 850,000 naira. Capital gain is 11.4 million. Capital gain tax of 10% is 1,140,000 naira. The capital gain arising on the Lagos building is exempted from capital gain tax because it relates to a compulsory acquisition of property by an authority that has the power to do so. B. The company can discharge its capital gain tax liability by claiming rollover relief from the disposal of the Ibadan building. Full rollover relief will be granted if the whole of the consideration of 15.5 million obtained from the sale of Ibadan building is reinvested in the construction of the Ogun building. The time limit within which the proceeds for the sale of the old asset must be reinvested in the new asset is a period beginning 12 months before the ending 12 months after the disposal of the old assets. Please note that the tax law did not specify the time limit for claiming rollover relief. Question 3. In April 2004, Dr. Mensah acquired a house at a cost of 60 million. Other acquisition expenses incurred were 100,000 for legal fee and 200,000 valuation fee. On 30 November 2004, a duplex was constructed in the excess space at a cost of 12 million. On June 1, 2005, the duplex was sold to Uncle Jimmy for 16 million. The actual market value was 20 million and the value of remaining property was 68 million. On 1 January 2006, Dr. Mensah sold the remaining property for 72 million after paying for the following expenses. A. Improvement prior to sale 1 million. B. Estate agency fee 400,000. C. Legal fees 120,000. D. Advertising 240,000, totaling 1,760,000 naira. Required. Compute the capital gain tax for the relevant year of assessment. Solution to question 3. Dr. Mensah. Computation of capital gain tax for 2005 and 2006 tax years. 2005, 1st of January 2005 to 31st of December 2005. Consideration received. Market value of duplex 20 million. Deduct cost of duplex 12 million. Capital gain is 8 million. Capital gain tax at 10% is 800,000 naira. For 2006, January to December 2006, consideration received was 72 million. Deduct incidental selling expenses, estate agency 400,000, legal fees 120,000, advertising 240,000, total incidental selling expenses equal 760,000. Deduct it from the consideration received of 72 million. The net proceed is 71,240,000 naira. Deduct cost of acquisition. Consideration paid was 60 million. Incidental cost of acquisition, legal fee 100,000, valuation fee 200,000, cost of improvement 1 million. The total cost of acquisition is 61,300,000. Then our capital gain is 9,940,000 naira. The capital gain tax at 10% is 994,000 naira. Question 4. Mention any 5 categories of instruments that are subject to stamp duties under the Stamp Duty Act Cap S8 LFN 2004. That's 4A. 4B. Meltdown Construction Limited purchased a bulldozer on hire purchase on 1 February 2007 and paid a sum of 28.5 million naira as a deposit on the purchase price. The cash price of the bulldozer at the time of purchase was 45 million naira, but Meltdown Construction Limited was allowed to pay the balance in 20 monthly installments of 1 million naira each, with effect from 1 March 2007. Required. Calculate the capital gain tax for the relevant year of assessment, assuming that the bulldozer was sold for 1. 48.4 million after the payment of installment on 3 December 2007. 2. 49.6 million after the payment of installment on 5 September 2008. Solution to question 4. Categories of instruments. 4A. Categories of instruments subject to stamp duties under the Stamp Duty Act Cap S8 LFN 2004 include 1. Agreement, 2. Appraisement, 3. Banknote, bill of exchange and promissory note, 4. Bill of exchange, 5. Bill of lading, 6. Contract note, 7. Conveyance on sale and other conveyance, 8. Duplicate and counterparts counterpart. 9. Exchange, partition or division. 10. Leases. 11. Letters or power of attorney and voting powers. 12. Marketable securities. 13. Mortgages. 14. Notarial act. 15. Policies of insurance. 16. Receipts. 17. Settlement. 18. Share warrants. 19. Warrants for goods. And 20. Share capital of companies. 21. Documents requiring postage stamp. And 22. Transaction in capital market. B1. Meltdown Construction Limited computation of capital gain for 2007 year of assessment. Sales proceed of bulldozer 48.4 million. Cost of bulldozer, deposits paid 28.5 million. Installments paid 10 months at 1 million naira each, that's 10 million. Interest portion paid, that's working 2, 1,750,000, totaling 8. Deduct the interest portion from the installment paid, which gives us 8,250,000. Add the deposit paid to the 8,250,000, totaling 36,750,000. Deduct the cost of bulldozer from the sales proceeds, then we have 11,650,000 naira. The capital gain tax thereon at 10% is 1,165,000 naira. Meltdown Construction Limited computation of capital gain tax for 2008 year of assessment. Kindly refer to your pack. Question 5. White Cleaner Limited is involved in dry cleaning business. The company acquired a building for the business within Shonibare Estate, Maryland in the year 2001 at a cost of 25 million. It also acquired dry cleaning equipment and a generating set at the cost of 5 million and 3.5 million respectively. The wrong location of the company coupled with the poor performance of equipment, some of which were refurbished but wrongly believed to be new, resulted in low patronage. The company resolved to make a new start in the year 2003 by selling off everything to use the proceeds to augment the acquisition of new ones. The building was sold for 30 million, while the equipment and generating set were sold for 3.5 million and 4.3 million, respectively. A new building was acquired on Victoria Island for the same business at 65 million, while the equipment and new generating set were acquired for 7.5 million and 3 million, respectively. You are required to compute A. The capital gain, B. The rollover relief available, if any, C. Capital gain tax payable, D. The cost on which the capital allowance will be granted to the company based on the newly acquired assets. Kindly refer to your study pack for the solution. Question 6. Enron Nigeria Limited is a company engaged in the manufacturing of nails. Due to fall in demand for its products, it decided to move its factory from Abeokuta to Lagos State. Concerted efforts were made to acquire land for the new factory in Ojodu village. The warehouse in Abeokuta, which cost 900,000 6 years earlier, was sold for 2.1 million in March 1998. The amount formed part of the cost of construction of the new factory at Ojodu village, which was completed in November 1998 at a cost of 2.8 million. In 1999, the Abeokuta factory, costing 1,850,000, was sold for 2,950,000. Out of the sales proceeds, 2.3 million was spent on the construction of the second factory in Ojodu village, while the balance of 650,000 was put in fixed deposit account to generate interest. Required: A. Compute the capital gain made on the project. B. Compute the capital gain tax payable. C. Suggest how the company can reduce the capital gain tax payable. This involves solution and it will be difficult to explain. Kindly refer to your study pack. This is the end of chapter 5. Thank you.